The biggest question that every option trader has is, how do you actually build a profitable strategy? In this video, I'm going to show you an exact checklist that you can use, literally 5 steps that professional traders use every single time they build a strategy. So stick with me through this video and it will completely change the way you think about the world of trading. So a real trading strategy needs to pass 5 criteria. It needs to be reproducible, it needs to have a clear thesis, it needs thorough testing, positive expected value, and risk management. If even one of those things is missing, then it's not a viable strategy. If you're making money without these things in place, really it's just luck. So let's walk through this checklist together, and I'm going to give you examples as we go so you can actually see these things in practice. All right, step 1 is reproducibility. A strategy is a reproducible idea if you can bet on the opportunity you observe again and again. If it only works once, then it's not really a strategy, it's just a one-off event. Could still be a good opportunity, but it's not a strategy. Let's use a poker example to talk about reproducibility. If you're a new poker player, a simple strategy might be go all in every time I have pocket aces. Getting pocket aces is a reproducible event. It will happen throughout your poker career. And it's not necessarily going to win every time you get it, but it does win on average, and that is a profitable action to take. In trading, reproducibility means that you can consistently apply your process under similar conditions and expect similar outcomes. And for that reason, the first question on your checklist should be, can I apply this idea consistently? Because if not, then it just doesn't make the cut. All right, up next is a thesis. A thesis is the reason you believe that the strategy should make money. It's the why behind what you're doing. For example, one thesis that we use at Predicting Alpha is this idea of the variance risk premium, or the tendency for implied volatility to overstate realized volatility. You see, equity markets have this persistent need for downside protection, which makes options systematically overpriced compared to what actually happens in reality. And by selling that insurance, you get paid to hold risks that other people don't want. That's actually a pretty straightforward thesis, and that points to something important, which is that your why doesn't need to be super complicated. And that is where historical data comes into play. But it does have to be clear. If you can't explain why you're supposed to get paid, then you probably aren't. All right, so step 3 now is testing. This is important because having a thesis is good, but you need to actually go and see if it works in practice. A strategy or idea that you have needs to be tested across multiple market conditions. What happens in a bull market? What happens in a bear market? What happens in a kangaroo market? Is that what they were calling it? Yeah, in a flat market. What happens if volatility just spikes one day? Take the idea of selling 30-day out-of-the-money puts on the market. We can literally backtest this idea over decades. And if we do that, what we see is a gradual rise in the P&L. Of course, it's not a straight line. This thing is very choppy, but overall, it does trend upwards. And of course, good backtesting is the proof that we need that allows us to say, hey, there might actually be some weight to what our thesis is saying. And this is what separates a thesis and a strategy from a guess. You actually take the idea that you have and go figure out if there's actually something to it before you just deploy it in your portfolio. All right, now step 4 is positive expected value. And this is truly the heartbeat of your strategy. The question is super simple, and we should have an answer to it by this step. If I repeat this trade over and over and over again, do I make money on average? Going back to our selling puts example, we do see that this strategy on average generates positive returns because the implied volatility outpaces the realized volatility. Just like placing bets on a coin that has a slight bias towards heads, even though you will have losing coin tosses or losing trades in the market, for example, we know that if we flip that coin enough or if we trade for long enough, on average, our return will end up being positive and we will reap the rewards of that bias. So the checklist item here is, have I proven that this strategy has positive expected value? If yes, then keep going. If no, then maybe stop. All right, step number 5 is risk management. And this one's important because even with the best strategy in the world, if you size it wrong, you will blow up. Risk management is about protecting your bankroll for long enough so that you can actually see your edge materialize. Even when you have an advantage, if you have, let's say, $100 to bet with, and you bet your whole $100 and then you're bankrupt, even if you have a 2% edge, which is a solid edge in statistical terms, you can still lose all of it on a single bet because you have a 48% chance of losing. And even though you're supposed to make money in the long run, if you lose it all on the first trade or the first bet, well, you're out of the game. So risk management is really about staying in the game long enough for your edge to materialize. With our short put example, we may use a rule such as never risk more than 20% in the worst case scenarios. That way you can stay in the game, right? Even with a rule like that, if volatility spikes massively, you're not going to lose enough where you will be taken out of the game completely. Another simple example of that would be the S&P 500 itself. Traders regularly buy S&P 500 stock, even though they know there have been massive drawdowns, like a 50% drawdown historically. But even when that happens, good traders don't panic sell because they understand the long-term expectancy of holding the S&P. They've seen this movie before, and you should think about your strategy in the same way. You should expect drawdowns, prepare for them, and make sure that you're sized in a way that allows you to stay in the game when they happen. All right, so let's recap the checklist together. When you are building a strategy, the first thing you need to think about is, can I reproduce the results? Meaning, can I run this opportunity again and again? Number 2 is to test your thesis. Do I actually know why this strategy should work? Number 3 is testing, which is, do I have the data to back up my reason for why this strategy should work? Number 4 is positive expected value, meaning, does the results of my testing show that I make money on average? And number 5 is risk management, which is, am I sizing my trades such that I can survive the drawdowns? If your strategy checks all 5 of these boxes, then you've got something real. And if not, well, don't give up hope. It's just back to the drawing board. The sad truth is that most people never actually get past step 1. They just chase random opportunities and call it strategy. But now you have some idea of what it takes to actually build a good strategy. And when you look at it on paper, sure, it looks quite simple, but remember, this is going to take some real work to accomplish. To get started, if you want to see some strategies that already check all these boxes, click the link below and take a free trial with us. We have a few of them in there that you can just learn everything about. We have a few of them in there where you can learn everything about them and get the tools needed to actually run them. Happy trading, everyone. I'll see you in the next video.